Hello, and this is a special edition of Global Business Insights focused on the just released July Purchasing Managers Index in Nigeria and also examining newly passed legislation to increase the cap on ways and means financing that can be extended by the Central Bank of Nigeria to support government funding. Just out today as protesters head for the streets, composite PMI in Nigeria decreased to 49.2 points in July from 50.1 points in June 2024, continuing a trend of decline, this time slipping into contraction in July. Also today, the Bank of England cut its interest rates to 5% in the first drop since March 2020, from 5.25% to 5%. The bank had rates at a 16-year high of 5.25% since August 2023 as it combated rising prices across the UK. The US Federal Reserve Monetary Committee voted unanimously yesterday to hold the federal funds rate target unchanged at 5.25% to 5.5%. Fed Chair Powell added that a September rate cut was still on the cards. Now to our first deep dive on Nigerian PMI data. According to the released July data, the Nigerian private sector slipped into contraction territory in June as steep price pressures hit demand and resulted in reductions in both business activity and new orders. Rising costs and selling prices continue to rise rapidly as confidence hit a new record low. Stanbic IBTC headline PMI declined for the second consecutive month to 49.2 points in July, also the lowest level since November 2023. Good news from the data is the resilience in job creation, as the report says rate of job creation picked up to the strongest in 2024 so far. Also, though prices continue to go up, the pace of inflation eased from that seen in June and was actually the slowest pace since May 2023. The PMI report says on a year-on-year basis, headline inflation may have peaked in June, with moderation expected to be seen in the second half of the year. The report's basis for this peaking scenario is that the year-on-year effects of PMS subsidy removal, which induced higher fuel prices and significant currency depreciation, which accompanied the FX unification, will have been fading. Also, the commencement of the primary harvest season in September will help food supply and depress prices. We also expect to see the impact of expanded food importation and removal of associated levies on imports. But analysts tend to differ, saying that it's Nigeria's exchange rate devaluation that is inflationary, not as much this removal of subsidy. As such, July inflation will more likely be worse than June, given steady weekly devaluation throughout July that must already have passed through to July CPI. To tame inflation, you must tame the exchange rate. Also, the government needs to stimulate the economy. Infrastructure projects, homes construction, higher minimum wage, all will inject spending appetite and maybe new vigor in the economy. Analysts observe that the PMI metric is difficult to interpret, also without clarity on what is happening to inventory. Yesterday, on the 31st of July, both chambers of the National Assembly raised the threshold for the ways and means advances by the Central Bank of Nigeria to the federal government from 5% to 10% of the previous year's revenue. This was supposedly to plug seasonal or temporary shortfalls, limiting ability to execute the year's budget. Although this does not justify past breaching of the low limit to the tune of 50% to over 300%, some have said the increase of ways and means to 10% is realistic, it's not excessive, and more tolerable than the previous experience under the President Muhammadu Buhari administration. While ways and means are typically used to plug spending gaps caused by seasonality issues, especially with revenue, it can be abused as a permanent tool to finance deficits, especially as revenues drop, and which of course will have an inflationary effect. Senior business analyst Likon Shote comments on this newly passed legislation.
But the fear is this: shall we continue to take loans to meet operational expenses? Because As you can see, the budget of Nigeria is always allocating about 30% to capital projects, and that is not encouraging enough. It shows that we either have big government that needs to be cut down, or we are wasteful, or somebody is stealing the money. Okay? And then if you are having to explore easy ways and means loan from the central bank, it also suggests that your revenue has problems. You and I know that oil, which forms a very big chunk of the budget revenue, is suffering from oil bunkering, stealing. And then, of course, this government and previous government have pledged oil production futures to repay loans. Somebody says that maybe the federal government is just going to be able to sell about 200,000 barrels per day of whatever it produces of crude oil. And that's very scary. So, should the government begin to continue to look for easy ways to spend money? Because when the government of President Muhammadu Buhari did this, we all condemned it. Is this government going to follow the same route? It's important for us to caution the government, and the government to actually be self-cautious, not to take advantage of this thing because, again, of the inflationary implications.
I see some issues, noting that when you compare government spend per capita with other peer economies, Nigeria's spend is inadequate. Revenue to GDP ratio is also very low. The size of the budget is limited given the population size and needs. And to make matters worse, recent revenues have also underperformed expectations. What matters even more, therefore, is not the quantum spent, but how judicious and disciplined expenditures are. First, there is need for transparency and discipline to adhere to the new limit. There should be strict guidelines with strong consequences for exceeding. The government should promptly tell Nigerians how revenues, spending, and deficits have fared in the first half of 2024 to start with, and what exactly these amounts were spent on for better clarity, transparency, and context. There's also a clarion call to reimagine size and scale of governance, making dramatic changes, especially in recurrent expenditures. Also, to raise cheaper funds, there is need to accelerate privatization and raising equity or sale of government assets to reduce the deficit or to find funds to invest in productive projects like technology infrastructure, education, welfare, and support for small and medium enterprises. The government needs to also stimulate growth of the economy with targeted support incentives to boost high growth potential sectors. The government also needs to set up an independent fiscal watchdog to monitor fiscal discipline and provide quarterly independent assessments to the public on how the monies are being spent. But on a day where Nigerians are groaning under high interest rates and record high inflation, many on the streets are also protesting. This will be received as yet another prelude to more profligacy. For a government that has passed 3 supplementary appropriation bills since coming to power 15 months back, raising ways and means suggests that claims that reforms have positively impacted revenues may not be true. For a regime that has recorded so much higher headline and food inflation for its 15 consecutive months in office, what solace is a doubling of money printing limit expected to offer a populace that are about to hit the streets to protest against high cost of living resulting from the inflation? This administration's central bank monetary policy has also hiked the monetary policy by as much as 450 basis points, with interest rates now at a prohibitive 26.75%. how much damage will the loosening of the Ways and Means limit do to their efforts to tame prices? Will the government and central bank be disciplined to keep to the limits? We have to wait and see. Before we sign off, here's a clip from the Bank of England governor speaking today after the decision to cut interest rates by 25 basis points.
So today we've cut bank rate by 0.25 percentage points to 5%. It was a finely balanced decision. Inflation has been exactly on our 2% target for 2 consecutive months. And inflationary pressures in the UK economy have eased much as expected. It was very nice to have music when I said, said that. But this is very welcome news, as the music suggested. Now, at the same time, the UK economy has been stronger in recent months, and this is very welcome too. But it does add to the risk that inflation could be higher than we expected if we cut interest rates too much or too quickly. And despite easing, services price inflation and domestic inflationary pressures do remain elevated. So we need to make sure that inflation stays low. We need to put the period of high inflation firmly behind us, and we need to be careful not to cut rates too much or too quickly, all the while monitoring the evidence on how inflationary pressures are evolving. And the best and most sustainable contribution that monetary policy can make to growth and prosperity is to ensure low and stable inflation, and an economy where people can plan for the future with confidence and in which money holds its value. We have truly come a long way in returning inflation to target. Chart 1, which just come up, shows the development of 12-month consumer price inflation since 2019. That's the white line. Inflation has fallen significantly from its peak. Over the past year alone, it's fallen from nearly 8% in June last year to 2% in the latest data for May and June. And we expect consumer price inflation to edge up again in the second half of the year, perhaps to around 2.75%. You can see that in the shaded area. But we then expect inflation to revert towards the 2% target over the next year. Now, under the surface, the decline in the headline number has been driven by lower goods price inflation, as reflected in negative contributions from energy prices, that's the orange bars, and fading contributions from food and other goods, that's purple and blue on the chart. As the effects of lower energy prices fade over the coming months, more of the headline inflation number will be driven by services price inflation. That's the yellow bars. So the stories behind the headline inflation numbers really only emerge as we dive deeper into price developments for goods and for services. The story on energy prices is worth repeating. After sharp rises following the start of the war in Ukraine, household energy prices fell significantly in the second half of last year, with large declines in the Ofgem price caps. These declines are currently pulling down on the annual measure of inflation. In the latest number for June, household energy price inflation was minus 27%. With a weight of 4% in the Consumer Price Index, that currently subtracts about a percentage point from headline inflation. Now, as last year's declines drop out of the annual comparison over the rest of this year, this negative contribution from household energy prices will fade. And that's the main reason why we expect headline inflation to edge up in the coming months. As chart 2 shows, core goods price inflation has also fallen sharply over the past 2 years. That's the orange line. And we expect it to remain muted in the coming months. Again, that's shown in the shaded area. These are goods traded in international markets, and with supply chains restoring themselves and signs of deflation emerging in some key supplier countries, most notably China, global goods price inflation should help keep goods price inflation low for UK consumers.
Well, that's it for me on Global Business Insights. This is Bode Shosani. Please subscribe on Facebook, LinkedIn, or YouTube, and X. Thank you so very much. Bye-bye.